A money launderer charges about 8 cents on every dirty dollar. That is a real number, pulled from 88 federal cases prosecuted between 2007 and 2024. A median fee for a service you will not find listed anywhere, run like a business with repeat clients and specializations. But the system designed to stop it catches less than 1% of every dollar that moves through. And once you see how the machine actually works, you start to understand why. The way most people picture money laundering is wrong. They imagine a drug dealer walking into a bank with a duffel bag, or some guy in a back room feeding cash into a counting machine. And that version skips past the part that makes the whole thing run. Money laundering is a service industry. The person who earns the dirty money and the person who cleans it are usually not the same person. A cartel boss does not sit down at a desk and figure out how to move $40 million through the banking system. He hires someone. That someone is a professional money launderer, and they operate the way any service provider operates. They have methods. They have infrastructure. They have a fee. And here's the detail that reframes the whole picture. The launderer does not need to commit the original crime. He does not need to sell drugs or hack a bank or run a fraud ring. His entire income comes from the wash itself. He is a middleman, a logistics provider for illegal cash. And like any logistics provider, his business runs on volume and reliability. Clean the money, return it minus the fee, do it again next month. The client comes back because finding someone you trust to move your illegal money and give most of it back is not easy. That fee varies. A study published in 2025 through Springer Nature looked at 88 large-scale criminal cases in the United States, all prosecuted between 2007 and 2024, and found a median commission of 8% across the board. Drug trafficking proceeds cost about 7% to clean. Fraud proceeds, roughly the same. But cybercrime money costs 26%. And that gap tells you something important. The fee is not random. It is priced by risk, the same way any insurance product is priced by risk. Cybercrime leaves a digital trail that is harder to obscure, so the launderer charges more for taking on that exposure. Drug cash, on the other hand, comes in physical bills with no record attached, so the price of cleaning it is lower. The complexity of the wash determines the price of the wash. Now, scale that fee against the size of the market. The United Nations Office on Drugs and Crime estimates that somewhere between $800 billion and $2 trillion is laundered globally every single year. That is 2 to 5% of the entire world's gross domestic product. At the low end of that range, an 8% median fee means the laundering industry itself, just the service layer, just the fee for the cleaning, generates roughly $64 billion a year. At the high end, it is closer to $160 billion. That is not a side hustle. That is an industry larger than most countries' entire economies. And the people running it treat it exactly that way. They have repeat clients. They have preferred methods. Some specialize in cash placement. Others specialize in moving money across borders. A few handle only real estate. They are specialists. The same way a tax accountant is a specialist, except the product is making illegally earned money look like it came from somewhere legal. And here is the part that keeps the whole machine turning. The reason professional launderers can charge what they charge, the reason they can build long-term client relationships, the reason this industry generates billions, is that the risk of getting caught is almost non-existent. The same report that estimated the global volume also measured how much of it law enforcement actually intercepts. The number they published was less than 1%. The precise estimate was around 0.2%, meaning for every $1,000 a criminal sends through the laundering process, about $2 gets seized. A money launderer operates in a market where the product is in constant demand. The customer base is loyal out of necessity, and the odds of getting caught run about 1 in 500. If you designed a business model from scratch, you could not build one with better margins. And the relationship between a launderer and his clients works the same way any professional relationship works: referrals. A cartel that uses a particular launderer successfully is not going to broadcast that name, but they will share it with trusted associates. The launderer builds a reputation the same way an accountant or a defense attorney does: reliability, discretion, and results. Some of them have handled the same clients for years, running money through the same channels month after month, adjusting the method only when a particular route gets too much attention. But how does the actual cleaning work? That starts with 3 stages that every method on Earth follows, whether the amount is $5,000 or $500 million. Every money laundering operation, no matter how simple or how complex, follows the same three-stage process: placement, layering, and integration. Think of it like a washing machine. Placement is loading the dirty clothes. Layering is the wash cycle. Integration is pulling out clean clothes and putting them back in the closet. Stage 1. Placement. This is the most dangerous step, and it is the step where the most launderers get caught. The problem is simple. You have a pile of cash that was earned illegally, and you need to get it into the financial system without anyone asking where it came from. In the United States, any cash transaction over $10,000 triggers a currency transaction report under the Bank Secrecy Act. The bank files it automatically. It goes to the Financial Crimes Enforcement Network, FinCEN. So, the most obvious move, walking into a bank with $50,000 in cash and depositing it, is also the move most likely to get you noticed. This is where structuring comes in, and you may have heard this called smurfing. The concept is straightforward. Instead of depositing $50,000 at once, you break it into smaller amounts: $7,000 at one branch, $8,500 at another, $6,000 at a third. Each one falls below the reporting threshold. And if you use different banks, different days, maybe even different people making the deposits on your behalf, the $50,000 enters the banking system in pieces too small for any single alert to catch. The people who make those deposits for you are called money mules. Some of them know exactly what they are doing. Others are recruited online, told they are working a remote job, and have no idea they are committing a federal crime. The FBI has specifically warned that students, job seekers, and people on dating apps are the most common recruitment targets. And here's the thing about structuring. It is itself a federal crime, separate from whatever generated the money. You can be convicted of structuring, even if the cash is completely legal. The act of deliberately splitting deposits to avoid the reporting threshold is the offense. Banks are also trained to watch for it, and their systems flag patterns of deposits that stay just under $10,000 across short time windows. So, a good launderer does not just split the deposits. He randomizes the amounts, the timing, the locations, and the people walking through the door. He makes the pattern look like noise instead of a sequence. One thing from you before we keep going. Drop a comment and tell me where you are watching this from. I want to know how far this one reaches. And if you are down there already, hitting that like button would mean a lot. Stage 2. Layering. This is where the real complexity lives, and it is the stage that makes the money hardest to trace. The goal is to create so many transactions, across so many accounts, in so many jurisdictions, that following the trail back to its origin becomes practically impossible. The basic version is a series of wire transfers. Money moves from a domestic bank account to an offshore account, then to a second offshore account in a different country, then back to a domestic account held by a shell company with no real operations and no employees. The shell company exists only on paper. Its sole purpose is to be a name on a bank account. The more advanced version layers in shell companies across multiple jurisdictions, each one owning a piece of the next. Company A in Delaware owns Company B in the British Virgin Islands, which owns Company C in Panama, which holds the bank account in Switzerland. Tracing the actual human being behind that stack of paper requires cooperation between 4 different countries' legal systems, and that cooperation is slow when it happens at all. Legal assistance requests between nations can take months. Some jurisdictions are not legally required to respond at all, and by the time one country issues a request, the money has already moved through the next 3. And this is the stage where speed matters most. A professional launderer does not park money in one offshore account and leave it. He moves it constantly. A wire goes from the Cayman Islands to Singapore, then to Latvia, then to a correspondent bank in New York. Each hop takes hours. Each hop crosses into a different regulatory system. By the time any single regulator sees a suspicious transaction, it has already left their jurisdiction. The layering works because no single authority has a view of the whole chain, and the most modern version skips traditional banking entirely. Cryptocurrency lets you move value between digital wallets without a bank in the middle. The money goes from one wallet to another, then gets traded through multiple exchanges for different cryptocurrencies, then converted back to cash in a jurisdiction with weaker reporting rules. Some operations use privacy coins specifically designed to make transactions untraceable. Others use decentralized exchanges that do not collect identity documents at all. In 2023, the crypto sector was the most heavily fined industry for anti-money laundering failures. Stage 3. Integration. This is the finish line. The money has been placed into the system and layered through enough transactions to obscure its origin. Now it re-enters the legitimate economy looking like it came from a legal source. The launderer buys real estate, opens a business, invests in stocks, buys luxury goods. The funds appear in a bank account attached to a company with an address and a tax filing. And as far as the records show, the money is clean. It came from a business that sold products or provided services. And crucially, once money is integrated, it earns more money. The real estate generates rental income. The business generates revenue. The investments generate returns. Dirty money, once cleaned, starts compounding like any other capital. That is the end state the entire process is designed to reach. And this is the point where the launderer takes his cut, the 8%. The fee for moving money from stage 1 to stage 3 without it getting flagged along the way. The client gets back 92 cents of every dirty dollar, fully integrated into the legitimate economy. The launderer pockets the rest. Now, those are the stages. The stages are the theory. What matters is how they play out in practice, because the specific methods launderers use are where the real engineering lives. The oldest method in the book, and still one of the most common. You buy or set up a business that handles large amounts of cash. Car washes, laundromats, nail salons, restaurants, parking garages, vending machine routes. The key feature is that these businesses have revenue that is difficult for anyone to independently verify. Think about a car wash. How many cars actually came through on a Tuesday in March? Nobody knows. There is no inventory to count, no physical product being shipped. So if the car wash reports that it washed 400 cars that day when it actually washed 200, nobody can prove otherwise. The extra revenue from those phantom 200 cars is dirty money, deposited as if it were legitimate business income. The money comes in through the front door of the business. It gets mixed with real revenue. It shows up on the tax return. The business pays taxes on it, which is part of the cost, and the rest comes out clean. Al Capone reportedly laundered upwards of $1 billion through exactly this kind of operation, using restaurants, nightclubs, and laundromats in Chicago during the 1920s and 1930s. The reason this method endures is that it solves the placement problem almost perfectly. The cash never has to enter the banking system as cash. It enters as business revenue, already mixed with legitimate earnings, already explained by an invoice or a sales record that was fabricated that morning. And the tax payment is the key detail people miss. A launderer who runs a cash business actually wants to pay taxes on the dirty money. That sounds backwards, but it is the whole point. Paying taxes on fabricated income is what gives that income a government-verified paper trail. The IRS is not going to question where money came from when it already collected its share. The tax payment is the price of legitimacy, and launderers treat it the same way they treat the 8% fee. It is a cost built into the service. If cash businesses handle the low end, real estate handles the high end, and the mechanics are different. A shell company, the kind with no employees and no real operations, purchases a luxury property. The purchase is made in cash, meaning no mortgage lender is involved. And when no lender is involved, there is no bank performing due diligence on where the money came from. FinCEN, the United States Treasury's Financial Crimes Unit, started issuing geographic targeting orders specifically to address this. They now require title insurance companies in major markets, including New York, Miami, Los Angeles, San Francisco, San Diego, San Antonio, and Honolulu to identify the real human being behind any shell company buying high-end residential real estate without a mortgage. And what they found confirmed the problem. About 30% of the transactions reported under those orders involved a buyer who had already been the subject of a suspicious activity report. 30%. Nearly 1 in 3 all-cash luxury purchases by shell companies involved someone the financial system had already flagged as suspicious. The property itself becomes the final stage of integration. It sits there appreciating in value. It generates rental income that is perfectly legal. And when it sells, the proceeds are clean money from a real estate transaction. The entire cycle, from dirty cash to clean real estate profit, is complete. And this is why certain real estate markets are saturated with laundered money. Miami, London, Vancouver, Dubai. These cities all share 2 features. Prices are high enough to absorb large volumes of cash in a single purchase, And foreign investment is common enough that an offshore shell company buying a condominium does not raise eyebrows. In some of these markets, entire floors of luxury towers sit empty. Nobody lives there. The unit was never purchased to be lived in. It was purchased to turn a sum of money from illegal to legal, and the condo sits empty until the owner decides to sell and cash out clean. This one is less well known, and it is enormous. Over half of compliance professionals surveyed in the State of Financial Crime Report listed trade-based money laundering as a top concern. The concept uses international trade as the vehicle. You have a company in one country that sells goods to a company in another country. On paper, the invoice says the shipment is worth $2 million. In reality, the goods inside are worth $500,000. The buyer pays the $2 million invoice, and the $1.5 million difference is dirty money that just crossed an international border disguised as a normal trade payment. It works in both directions. You can over-invoice, where the exporter receives more money than the goods are worth. Or you can under-invoice, where the importer receives goods worth more than what they paid, and the difference in value gets transferred to whoever controls the goods on the other end. You can even submit multiple invoices for the same shipment and collect payment twice. The reason this method is so hard to catch is that international trade involves millions of transactions per day across thousands of ports, and no single customs authority has the capacity to verify that every invoice matches the actual contents of every container. The complexity is the cover. And unlike a wire transfer, which at least leaves a trail inside the banking system, a trade invoice just looks like commerce. Two companies did business. Money changed hands. Goods crossed a border. Every piece of that transaction looks normal because trade is normal. The laundering hides inside the ordinary flow of the global economy, and picking it out requires knowing the real value of every shipment on every vessel in every port in the world. Nobody has that information. Walk into a casino with $50,000 in cash. Buy chips. Gamble for an hour, maybe lose a few hundred, maybe win a few hundred, then cash out. The casino gives you a check or a wire transfer for your chip value, and now you have funds from a casino, not from whatever you actually did to earn the money. If you have been here this long and you are not subscribed, now is the time. Hit subscribe so you do not miss the next one. And seriously, let me know where you are watching from, because these comments are half the reason I make these. Some operations take it further. A launderer deliberately loses to an accomplice at a poker table. The accomplice collects the winnings. The casino records the accomplice as a lucky gambler, and the payout is clean. Others buy chips and never gamble at all, just trading cash for a casino check at a small loss. Casinos have historically collected less identification from customers than banks do, which made them a natural vehicle. Regulations have tightened, but the volume of transactions on a busy casino floor, thousands per hour, still makes individual scrutiny difficult. And online gambling has opened up a new front entirely. A launderer deposits dirty money into an online casino account, places a few low-risk bets, and withdraws the balance as gambling winnings. The transaction history shows a gambler, not a criminal. And online platforms operating from jurisdictions with minimal oversight make the paper trail even thinner than a physical casino would. Sometimes the method is not a car wash or a shell company. Sometimes it is the bank. Wachovia, one of the largest banks in the United States at the time, processed up to $350 billion in suspicious transactions connected to Mexican drug cartels. Drug money was smuggled across the border, deposited with Mexican currency exchanges, and then wired into Wachovia's United States accounts. The bank's anti-money laundering controls failed to catch it. Wachovia settled the case by paying $110 million in asset forfeiture, which was a fraction of 1% of the money that moved through. HSBC paid $1.9 billion for similar failures, the largest penalty of its kind at the time. Drug cartels had been laundering hundreds of millions through the bank's Mexican operations, and the controls that were supposed to catch it did not work. These are not cases of banks deliberately laundering money, though those exist too. These are cases of banks failing to catch what was moving through their own systems. And the scale of what slipped through tells you something about how effective those systems actually are. And notice the incentive structure. The bank makes money on every transaction it processes. Every wire transfer generates a fee. Every account generates revenue. The money flowing through is, from the bank's perspective, business. Compliance is a cost center. The people building the monitoring systems are not trying to maximize catches. They are trying to meet the legal minimum required to avoid a fine. And the fine, when it comes, is almost always smaller than the revenue the transactions generated. The math does not point toward vigilance. It points toward just enough compliance to stay out of criminal court. Here is the part that ties all of this together. The system designed to catch money laundering is one of the most expensive regulatory frameworks on Earth, and by its own numbers, it barely works. United States and Canadian financial institutions spent $31.5 billion on anti-money laundering compliance in 2019 alone. That covers the software, the compliance officers, the transaction monitoring systems, the suspicious activity reports, all of it. $31.5 billion in a single year. The result? Anti-money laundering efforts recover approximately 0.1% of criminal funds globally. Not 1%, 1/10 of 1%. For every $1,000 in dirty money that enters the system, $1 comes back. And the reason is built into the architecture. Banks are required to file suspicious activity reports whenever a transaction looks unusual. But the definition of unusual is broad. The volume of transactions is enormous, and the monitoring systems generate so many alerts that 95% of them turn out to be false positives. 95%. That means compliance teams spend almost all of their time investigating transactions that turn out to be completely legitimate, while the actual laundering slips through in the noise. Think about what that means in practice. A compliance officer at a major bank reviews hundreds of flagged transactions per week. 19 out of every 20 are nothing. By the time the one real alert shows up, it looks exactly like the 19 that were not real. The analyst is fatigued. The pattern looks the same as the last 50 patterns that turned out to be someone buying a boat or wiring money to a relative overseas. The volume of legitimate transactions drowns the signal, and the launderers know exactly what the monitoring systems are calibrated to catch because the regulations are public. The $10,000 threshold is public knowledge. The patterns that trigger alerts are described in compliance training materials that anyone can read, and the launderers know this. That is why structuring works. That is why shell companies work. That is why trade-based laundering works. Every method exploits the same fundamental weakness. The financial system processes trillions of dollars per day, and no monitoring system can examine each transaction with the scrutiny that catching a professional launderer requires. The penalties, when they come, reinforce the problem. Wachovia moved $350 billion in suspicious transfers and paid $110 million. That is roughly 0.03% of the amount that flowed through. For HSBC, the $1.9 billion fine was the largest ever, and the bank's annual revenue that year was more than $50 billion. The fines are a cost of doing business, not a deterrent. And in almost every case, no individual bank executive goes to prison. The institution pays, the stock dips for a quarter, and the bank continues operating. The penalty lands on the quarterly balance sheet, not on any individual person. And for the professional launderer running a small operation, cleaning $5 million a year at 8%, that is $400,000 in annual income from a business that has a 99.8% chance of never being caught. The math works too well for the market to shrink. There is one more piece to the failure, and it is the most structural one. The countries that profit most from laundered money have the least incentive to stop it. Offshore financial centers, certain Caribbean nations, parts of Southeast Asia, these places earn real economic value from the capital flowing through. Shell company registration fees, banking fees, real estate transactions, professional service fees for the lawyers and accountants who set up the structures. Shutting down money laundering would mean shutting down a meaningful portion of their economy. And so the international cooperation that enforcement depends on runs directly into the economic self-interest of the jurisdictions it needs to cooperate. That is the machine. Dirty money enters through cash, businesses, real estate, trade invoices, casinos, and the banking system itself. It passes through layers of shell companies and wire transfers and crypto wallets. It comes out the other side looking like business income or investment returns or property sales. And the person who ran the wash collects 8 cents of every dollar for a service. The world spends $31.5 billion a year trying to prevent and recovers 1/10 of 1 cent on every dollar it chases. The system is not broken. It is working exactly the way its structure guarantees it will. The money is too fast, the borders are too many, and the incentives point in the wrong direction at every level. If you made it to the end of this one, do me a favor. Hit subscribe if you have not already, drop a like, and tell me in the comments where you are watching this from. I read every single one.